Busy morning on Wall Street this morning. United Technologies travelers are already out with their third quarter earnings. We've got some disappointing numbers from IBM. That stock is down almost 5% this morning. Joining us right now to handicap it all is Mainstay Capital CEO and Chief Investment Strategist David Kudla. David, good to see you. How are you, my friend?
Good morning.
When you look at the earnings picture right now and the backdrop for investing, is this a reason to buy stocks or do you raise cash?
I think it's a reason to buy stocks. You know, we have an earnings trough that we're working through. It's going to be the second quarter of negative earnings based on consensus estimates. We have seen some beats, as much as 80%, 50% on revenues. Some disappointing news here in some of these early earnings reports. But we think there's some opportunity for surprises on the upside. We've seen a recovery in the market. We've got to work through this earnings trough, but we still think we're in a long-term secular bull market. Dips like we had in August and September are an opportunity for long-term investors to buy.
David, going back, to the beginning of the year or even 3 to 6 months ago, were you calling for down 4% revenue growth in the S&P 500 and then down 10% earnings? And do you find any narrative kind of adrift in the reason to be long now?
Well, we looked at 2015, the beginning of this year, we looked at it to be a year where there would be the S&P 500, the index, not doing much. Volatility, plus or minus 3 or 4%, with a correction somewhere along the way. Now, we were maybe early on calling for that correction, but we thought this year we'd finally get our 10% correction that when it came, we'd been waiting for 4 years. Mm-hmm. So with that, that's created, consolidated stocks a little bit, some backing and filling, and we've seen a retreat. We saw a retreat again in September, but we think that the fourth quarter is going to turn out to be pretty good for stocks, and we're still looking for positive returns in 2016. Although we know that the best years of this bull market are in the rearview mirror. But we're still constructive on stocks going forward.
Yeah, that's the real debate that we have with investors is this the bottom in earnings expectations, or is it not till the middle of next year? I obviously side onto the middle of next year.
David, I want to give you two different scenarios and ask you how the market reacts to each one. So in scenario one, the Fed keeps interest rates at 0 through 2015. We go into next year with no change in interest rates. Scenario two is they move in December after all this toing and froing. How does the market respond in each of those scenarios?
Yeah, good question. Does it matter?
Mm-hmm.
Well, and I think it's how they communicate it. There were a lot of analysts going into the September meeting that thought we would get the rate hike. The conversation around it that, we didn't get the rate hike. That was meant to decrease volatility. We saw the volatility anyway. Concerns about China and global growth. I think as we go forward, now there's a belief that the rate hike, I think generally the rate hike is not coming till next year, so stocks are doing a little bit better. I think it's how they communicate it, how transparent they are about the rate hike, and the economic data that accompanies it. As we've said all along, rates can go higher and stocks can go higher along with that as long as the economy is improving, as long as those rate increases are accompanied by a strong economic growth.
Yeah, David, let me broaden you out across the world here. I know you like U.S. stocks. What about Europe? You've got an ECB meeting happening this Thursday. Do you want to buy Europe ahead of that? And how would you characterize what's happening in the Eurozone after the stimulus we've seen? Does Mario Draghi have to do something this Thursday?
Well, what's interesting, because the Fed is not hiking rates, that puts pressure on the ECB and in Japan on Kuroda to look at, do they need to ease further? We think that the euro needs to decline so they have that competitive advantage. We think the euro needs to decline from where it is now. And if the Fed is not hiking rates to strengthen the dollar here, they need to look at more monetary stimulus there. In lieu of that, we still like Europe because the fundamentals are good there in terms of their economic growth, slow but growing. We like Japan as well.
All right, so you like developed markets. David, good to have you on the program today. Thanks so much.
Thank you.
We'll see you soon. David Kudla there, Mainstay Capital. Coming up the